Welcome in the first lecture in risk management. In this course, we will focus on study management of risks in a bank, corporation, and we will focus on what are main types of the risk. What is the meaning of the risk? Also, we will study how can the risk measures. Also, how can the risk eliminated? And why the individual and the bank care about the risk. Let us start in the first lecture. In this course, we will discuss 8 subjects. In the first lecture, we will discuss risk and risk management. In the second lecture, we will discuss banking regulations. Lecture number 3, we will discuss interest rate risk. In lecture number 4, we will discuss market risk. Lecture number 5, credit risk. Lecture number 6, foreign currencies risk. Lecture number 7, we will discuss liquidity risk. And lecture number 8, we will discuss liability and liquidity management. The first lecture, risk and risk management. This chapter discusses asset and uncertainty risk and exposure to risk, broad classes of financial risk, banking regulations, and risk management. In beginning, what is meaning the risk? Risk has been defined in various ways across time. Some definitions refers to probability of an event. Other refers to uncertainty of outcomes, positive or negative. The risk in finance defined as randomness of return of an investment, including both positive or negative outcomes. Under this definition, we can say when expect high return, that will be associated with high variability in outcomes. In the financial industry, the view of risk is different. Risk is defined by uncertainty that has adverse consequences on earning or wealth, or the uncertainty associated with negative outcomes only. Now, main objective for any corporation to maximize the wealth. If we need to maximize the wealth, that will be associated with the risk. For that, main roles for risk managers to accountable, evaluating, and controlling consequences of adverse events for the firm. Under this view, we can see the risk as potential of loss resulting from the interaction with uncertainty. The interaction arises from exposure of financial firms such as randomness. Exposure is extent to which a business could be affected by certain factors that may have a negative impact of return of any investment. For example, foreign currency or foreign exchange rate. When be exposure in foreign exchange rate, that will affect on size of return of the investment. The uncertainty cannot be eliminated, but the exposure to uncertainty can be changed. Example, we cannot eliminate it on foreign currency, but we can to reduce the exposure to uncertainty. The exposure can be long or short. Being long is the conventional practice for investing in the assets or portfolio. The holder of an asset is long and the risk is that asset value declines. A short position can be seen as the mirror image of long position and gains when assets value move down. Investing a short position is the sale of board assets such as a stock. Risk management, organization and roles. A risk regulation developed and standard practice for risk management spread across the industry. Some common views on the organization of the risk management process emerged. We will discuss banking regulation in lecture number 2. Board classes financial risk. Financial risks are defined according to sources of uncertainty. The broad classes of financial risk are credit risk, liquidity risk, interest rate of risk, divided into subclasses relative to specific events that trigger losses. Now, broad classes of financial risk. We will start to short definition for credit risk. Credit risk is the risk of loss due borrower's default. Default risk is the risk that borrowers fail to comply with debt obligations. Market risk. Market risk is risk to loss associated with the adverse of market movements, depressing the value of the position held by market players. We will discuss market risk in lecture number 5. Liquidity risk. Liquidity risk defined as the risk of not being able to raise the cash when the company doesn't have ability to repay the obligations because there is a problem in the cash. Banking firms raise cash by borrowing or by selling financial assets in market. When any company need to convert some assets to cash, that's associated with liquidity risk. Interest rate risk. The interest rate risk associated with decline of interest gains or interest income. Also, interest revenue minus interest cost. That's risk associated with the movement of interest rates. The variety in interest rate will affect on the revenue of the investment. When the interest rate going up or going down, that's always affected on the revenue or size of revenue of the investment. We will discuss interest rate in lecture number 3. Foreign exchange risk. Foreign exchange risk is the risk of incurring losses. That's type associated with the variety in foreign exchange rates. The variability in the foreign exchange will affect on the revenues. When the rates of currencies going up or going down, that will affect on the investment. Also, this type associated with transaction risk, when we need to evaluate the assets or liabilities denominated in foreign currencies. We will discuss foreign exchange risk in lecture number 6. Risk management. Now, main version for any company try to maximize the investment and reduce the risk. For that, risk management requires that the risk of financial institution be identified, assessed, and controlled. Enterprise risk management addresses combination of credit risk, liquidity risk, interest rate risk, liquidity risk, and operational risk. Sound risk practice define who should be accountable on this risk and how the risk process should be implemented. For main role for the management to evaluating and controlling the consequences, the events associated with the firms. For that, there are many policies and strategies associated with the risk. Risk process include the identification and control of the risk. Risk models serve for measuring and quantifying the risk and provide the input for the management process and decision. This process will help us to make our decision because we will evaluate any project, any activities. We will evaluate the return. We will evaluate the risk. For that, this process will help us to make our decisions. All risk process imply that risk policies be properly defined and the risk appetite of the firm will be defined. The common process for controlling risk based on risk limits and risk diligence. For that, main roles for risk managers to evaluating all the process, all the procedures associated with the activities to reduce the risk size. If we can to reduce the risk, we can to improve our return of the investments. The Asset and Liability Management Department. The Assets Liability Management Department is managing the assets and funding the balance sheet of bank and controlling the liquidity and interest rate risk. Main function for asset and liability management is the finance function of bank, is often located in finance department. The scope of asset and liability management extended mainly to banking portfolio and less so to trading activities because they rely primarily on short-term financing. We will discuss this subject in lecture number 8. So, in this lecture was introduction about risk management. We explained what is the meaning of the risk associated with probability and uncertainty. Also explained what's main roles for risk managers to reduce the risk and managing, also controlling consequences and events for the firms. Also explained main types of financial risk. We will explain all financial risk in next lectures. Next lecture will discuss banking regulations that's associated with Basel standards, and also we will discuss capital adequacy. Thank you for your attention and see you in next lecture.